Okay, great. Good afternoon, everyone. And I'm sorry I cannot be in person with you today due to flight cancellation, sadly. So I'd like to thank the organizers for allowing me to present online. This is actually the update of my job market paper, which is now entitled Data-Driven Investors. And I think the motivation for that paper is pretty straightforward, given the theme of this conference and given how big the adoption of data technologies such as machine learning, big data analytics has been in financial services. And when you think about those technologies, what do? Well, they most of the time are used to generate forecasts. They are forecasting machines. And they generate those forecasts by identifying patterns in historical data. So they bet on the fact that those patterns that can be identified in historical data are going to repeat themselves out of sample in the next sample or in the future, so to speak. And one consequence of this is that, well, you can obtain reasonably accurate predictions using those technologies in familiar context. So in a context that's going to look like a similar data generating process, quote unquote. In contrast, you're going to get low effectiveness with those technologies when you face rare and novel scenarios. And I believe this trade-off is important to study for investors, and because this can have implication for the allocation of capital in the economy. And so in this paper, I'm using venture capitalists as a laboratory. So why VCs? Because VCs are a specific type of investors. They finance high growth, innovative startups. And in recent years, well, a number of VCs have adopted data technologies to screen startups, that is to select and evaluate startups. So this is just a screenshot of one survey that has been run by PitchBook, asking VC firms whether they currently or plan to use machine learning to inform their investment decisions. So you can see at the bottom in red, you have a bunch of firms saying that they currently use those tools. At the top, you have also a bunch of firms saying that they plan on increasing usage. So the bottom line, this is becoming more and more common in the VC industry. So again, why VCs? Well, because the trade-off I've mentioned is actually exacerbated in the VC industry. VCs are supposed to finance novel ideas that are almost by definition not in a training sample, not in historical data, but those data technologies are going to detect pattern in historical data. And so what this paper shows is that there is actually a potential downside to the adoption of data technologies, which is it's going to give a comparative advantage to investors, but to screen businesses that are more prevalent in historical data, as opposed to the most novel ones. So now what do I do in the paper in terms of methodology? I identify what I would call data-driven VCs using VC employee data. So I'm going to detect the VC firm that starts hiring data scientists, machine learning engineers to build some form of data infrastructure. And then the second piece of methodology that is key in the paper is, yes.
Actually, can you speak a little softer? It's somehow very, very loud here, and we can't figure out how to turn the volume down on our end.
Okay, sure. I'm gonna try to control this. I don't have the impression I'm speaking super loud here, but I'm gonna do my best. So the second proxy, the second piece of methodology is a proxy for whether a startup is likely to be a good fit for data technology, likely to be a good fit to be assessed by those tools. And here, I'm going to be using a textual analysis to measure to what extent a startup is developing a business that has been already explored versus that is totally new. The idea being that if a startup develops a business that is already explored, already tested, there are going to be more historical data on that type of business, more relevant data to be processed by those tools to screen this particular startup. Then I'm going to show you evidence that are consistent with data technologies, providing a comparative advantage at first screening those already explored businesses, as opposed to the novel ones. And secondly, at forecasting frequent outcomes. What I mean by frequent outcomes are frequent outcomes in historical data. Think about failures, think about funding rounds of startups, as opposed to more rare IPOs and major successes. So I'm going to provide evidence that data technology provide a comparative advantage at those two type of tasks. And then I'm going to try to convince you that there's some form of causality between the adoption of those tools and the effects I've just mentioned. And here I'm going to be using an identification strategy leveraging plausibly exogenous variation in VC's screening automation, making them more likely to adopt this type of technology to automate due to the advent of Amazon Web Services. And I'm going to give you more details about this in the presentation. So brief summary of the paper. Think about VCs facing startups. Some of those startups at the top are developing, let's say, already tested businesses, high backward similarity startups in my terminology. At the bottom, you have the startups developing more novel businesses. You have this VC adopting those data technologies, and you observe new investment by this VC. Well, what I'm going to show you is that first, after adopting those tools, there's a tilt in those VC portfolios. So those VC, they become twice more likely to invest in the pool at the top, which is composed of already tested businesses. Now, is this because they have a comparative advantage at screening this type of startups? Well, if you look at overall, the likelihood of picking startup that fail is going to be going down for those VCs. But it's going to be going down only in the pool at the top, only in this pool of already tested businesses, consistent with VCs getting better at avoiding the failures in that pool, which is informed by historical data. However, if you look at the more extreme outcomes, the rare outcomes in the training sample, so to speak, well, they're going to become less likely to achieve those major success as measured by IPO, profitable acquisition. So those are going to be the main results of the paper. Let me briefly mention the data I'm using. So my main data set is going to come from Crunchbase. So I'm going to exploit the VC investments provided by Crunchbase. That's going to be an international sample. And I'm using this data set mainly because it provides also extensive information on the history of VC employees. And that's going to be my methodology to identify those VCs building data infrastructure. I'm also matching this data set with additional databases such as patent, fund level data. And my final sample is from 2000 to 2019. And I'm able to observe outcomes up to 2021. How do I identify those data-driven VCs? As I said, I'm going to be using those VC employee data. So long story short, I'm going to start with an initial list of VC that are vocal about the use of those tools. I'm going to match those VCs in Crunchbase. And thanks to the database provided by Crunchbase on employees, I'm going to get the full history of those VCs, employees and jobs. Among those jobs, I'm going to identify those that are related to the implementation of data technology. Think about machine learning engineer. I'm just going to show you an example in a minute. I'm going to extract those keywords from those jobs that are specifically related to the implementation of those tools. And then I'm going to search for those keywords in the entire set of all jobs at all VC firms that I can find in the Crunchbase database. I'm going to exclude the employees that are classified as board member, observer, and so on, that are basically, the idea here is that I want to remove employees that are advising their portfolio companies, employees that are just data scientists hired to help their portfolio companies, not really implementing a data infrastructure at the VC firm. And then the VC is going to be classified as data-driven from the date it hires one of those data-related employees. So this is one example here. So you have Jonathan something at Tesla Venture. He's a data scientist building out data infrastructure operation algorithms. So clearly you see that this person is actually building up a data technology tools at this Tesla Venture VC firm. This is the evolution of the number and the fraction of VC firms that I classify as data-driven in the sample over time, thanks to this methodology. Now, the second piece of the methodology that is important in the paper is this notion of backward similarity. So again, the idea is that those algorithms are designed to identify patterns in historical data on past startups. And the hypothesis I try to present at the beginning is that, well, those past patterns are mainly relevant to screen startups that you can compare to those in historical data. So those patterns are going to be helpful if the sample in which you're trying to make forecast is closely related to the sample on which you have trained those tools. And I'm going to proxy for how close you are from historical data by measuring the similarity of the startup business to those of the past. I'm going to use a textual similarity measure to compute this backward similarity proxy. So I'm going to compute the textual similarity of a startup business description to those that were previously funded in the same industry that I can observe in the sample. And so here the intuition is that if you have a high backward similarity, well, your business is supposed to be similar to those that have been already tried, already tested in the past. Therefore, historical data are likely to be relevant for our algorithm. So that's going to be my measure of how good is the fit between this startup to be screened by those data technologies. Now, what do you observe in terms of investment after VC adopt those data technology tools? Well, if you look at the number of investment they make, they're clearly a scale up in terms of number of investment made by VCs after they adopt those type of technology. So if you look at an event study around the adoption of those tools, well, actually, number of investment is going to be going up, clearly. Clearly, it's going to be going up by about 20 to 30%. This is what you observe in the sample. However, you will see that, in fact, those VCs, they scale up mainly towards the startup that are developing those already tested businesses. So if you look at the number of investments that are made by those VCs and this in two types of startups, at the top, you have startups that are ranked low in terms of backward similarity. So those are the novel businesses, according to my proxy. At the bottom, you have the startups that are ranked high on those backward similarity. And you see that it's pretty flat in terms of number of investment in those novel businesses, but at the bottom, you see that it's clearly going up. So they scale up, but they scale up mainly toward this pool of already tested businesses. Now, what about the investment outcomes? So one type of frequent outcomes you can find in the sample is survival and follow-up. And again, if you look at an event study around the adoption of those tools, of how likely VCs are to pick startups that survive and that raise follow-on funding. Well, clearly you see that it's going to be going up. It's going to be going up. And here I just want to mention that you have high dimension fixed effect like industry times country times year times stage. So I'm trying to saturate as much as I can the regression to really compare deals that can be compared to each other. So it seems that they get better at avoiding the failures. That's the key message of this slide. However, you will see that in fact, this is only when they invest in the backward similarity startups. So if I just show you what is the change in the likelihood that they pick a startup that survive and that raise follow-on funding after they adopt those tools, and the different quartiles of backward similarity. And here I'm showing you the coefficient in each quartile of backward similarity, where you see that in fact, it's really in quartile number 4 that they get better at avoiding the failures. So bottom line, they scale up the portfolio toward this pool of already tested businesses, but it seems that it's because they get a comparative advantage now at screening those startups in a sense that they get much better at avoiding the failures in this pool of already tested businesses. What about the more rare outcomes, such as the major successes? Think about IPO, major acquisition. Well, in fact, if you look at the same type of event study, you're going to see that it's actually going down after they adopt those tools. So those VCs scale up, they go in the pool of already tested businesses, they get better at screening in the sense that they avoid the failures that are quite frequent in the training sample, quote unquote, but at the same time, they get, in a sense, worse at picking those major successes that are not that frequent in the training sample. Now, let me talk a little bit about whether we can interpret those as causal effects of adopting those tools, because obviously the main issue here is that there could be many omitted variables that are correlated with the adoption of those type of technology. So in an ideal experiment, you would like to have exogenous variation in data technologies adoption. And obviously, this is something that's going to be very hard to find empirically. So I'm going to try to set up an identification strategy that leverage plausibly exogenous variation across VCs in their screening automation. The idea being that if you automate your screening, you're more likely to adopt those data tools and therefore to become data-driven. So the shock I'm going to be using is a shock to the number of potential investment opportunities VCs have to evaluate. And this is, I think, better summarized by this quote that's from Crunchbase News. So they clearly explain that the rate at which startups are funded is nearly impossible to keep up with. And investors are turning more to data science to keep up with the volume of companies in a period where it's nearly impossible to perform due diligence on every company in a given space. So there is some need of automation on the VC side. So the natural experiment I'm going to be using is the introduction of Amazon Web Services in 2006. And this is a shock that has been also studied by Mike, showing that there is a drop in the cost of starting businesses in software and web-related companies. The idea is that you're going to have the cloud that becomes available, and you're going to have all those entrepreneurs that can now start using the cloud instead of buying high fixed cost data infrastructure themselves. They're going to be able to start businesses at a lower cost. And this is going to create a boom in startup creation and in these industries, and therefore a boom in the number of investment opportunities for VC firms. And in my story, that's going to be an increase in VC's incentive to adopt those data technologies to automate their screening. And that's going to be kind of my instrument for data technologies adoption. So here is a summary of the identification strategy. Think about two types of industries, e-commerce industries and 3D printers. E-commerce has an exposure of 1 to the shock because entrepreneurs are likely to benefit a lot from the availability of the cloud. E-commerce entrepreneurs, if there's Amazon Web Services out there, you're going to benefit a lot. That's going to be much cheaper to start a business. 3D printers, not so much. So you have startups in both industry, you have VCs, and this is before the shock. Before the shock, I'm going to be looking at VC's portfolio, and I'm going to compute VC's exposure according to their portfolio. So I'm going to say here that VC1 has an exposure that is 0.6, much greater than VC2, because VC1 has invested in the past in the e-commerce and in 3D printers. So if there is a boom in e-commerce in the number of startups, VC1 is much more likely to be affected than is VC2. There is the cloud popping up. There are new startups that are created, more so in the e-commerce industry. And here, the first step, the first stage of this analysis is going to be to check whether VC1 is actually more likely to become data-driven, to adopt those tools. And then I'm going to be looking at the new investments that are made by VC firms, and to make sure I'm not going to be driven only by composition effect. I'm going to be comparing investments that are made before and after the shock within a given market segment. So I'm going to be comparing before after by VC1 versus before after of VC2, but when they invest in the same industry. And I'm going to show you results where they invest in the affected industry, in the e-commerce industry, but also in the industry that are not affected by the shock. So this is the first stage of the analysis, so to speak. So here, that's a defender at the D level. And the first result that is key here is that if you look at VC exposure time post, well, actually the VC that are the most exposed are much more likely to become data-driven. So they are much more likely to make investments that are classified as data-driven according to my methodology. Exposed VCs are more likely to become data-driven. What is important is that when you start interacting the post with the similarity quartile, well, in fact, you will see that those VCs are actually much more present, much more likely to be present afterward in this top quartile of backward similarity. So in the quartile of startups that are actually those already tested businesses I mentioned before. So they are more exposed, they adopt the technology, and they shift the portfolio in the direction of those backward similarity startups. In terms of outcomes, if you look at the likelihood of picking startups that do not fail, survival and follow-on. Well, if you look at the most exposed VCs, well, actually there's a positive effect, but that is not really statistically significant. It's really when you interact with the backward similarity that you see that there is this effect in the top quartile. So again, those VCs that are the most exposed, they are more likely to adopt the tool, and they become better at avoiding the failures, but only in the pool of the most backward similarity startups, the most already tested businesses. If you look at the likelihood of major success, well, actually you have the same negative effect I've mentioned before. And this is the dynamics of the effect over time. You see that after a few years, they become much less likely to pick up those breakthrough success. So to conclude, I believe those results are consistent with this idea that all those data technologies that we see everywhere, actually, they exploit historical data that are mostly informative about, well, the training sample. So in that case, the businesses that have been already explored. And there is kind of a potential downside that is associated with the adoption of those tools, which is it's going to provide you with comparative advantage, but only to screen those already explored businesses and the frequent outcomes that you can observe in the training sample. So potentially you're going to focus relatively more on this business or more on these outcomes, and this can have potential implication, maybe beyond the scope of this paper, but capital directed to breakthrough innovation and potentially even long-term growth effects. And I'm going to stop here to be on time. I'm looking forward to Mike's discussion, and thank you very much for having me today.
According to schedule, welcome to the reception. Hope everyone has a drink. I know it's starting out. It's probably the most boring reception you'll have in the next 10 minutes, but I'll do my best. So thanks to the organizers for having me. One second. Oh boy. I got it. I think it's this. There we go. There. It's got my name in it. Okay. And then I need a little. Sorry guys. Sorry what I'm doing. Roll L, then no. Maxime, you can see this, right? The IT guys were here doing. That's good enough, right? Got drinks. Okay. Thanks for having me. Happy to discuss this paper. Let's start. Paper in one slide. Doing my job of summarizing things. The research question is my perspective. This is a rewritten job market paper, as Maxime highlighted. And I noticed the changes given I've read this paper a couple times. So this has informed my summary of the paper a little bit. So the research question is, what happens when investors, VCs, use historical data in a rare event setting? And they do. They change. How do these changes impact the spread of innovation? I think the presentation didn't do enough service to this piece in the paper, and we'll talk about that in a second. Motivation is data has entered pretty much. Data is everywhere in finance, venture, and PE. It's sort of the last place that it's entered in a rigorous way, and so you could argue we have a big gap in our knowledge there. Next, the methods and data is really impressive. Tracking people, investment strategies, and outcomes. All of these are difficult. I know from experience in this space, and it's an impressive undertaking. Overall, find that VCs that have data scientists or proxies therein, they overinvest what I'm going to call boring startups, at least from the perspective of venture. This affects their performance, i.e. the funds, and there's evidence that this is causal, that the story is tied to a causal change in the data scientist piece. And this matters a lot. One important implication here is that the data scientists at these firms, full disclosure, I kind of was one of these back in the day, should read this paper because it shows they're doing it wrong, right? They're basically making mistakes. And the investment decisions they make, flip side, this is nice, the investment decisions they make matter. They're actually changing the investment or the innovation. So overall, this is a great example of careful empirics, really high quality data, doing the best with what you can, and I believe what's going on. That's usually the best praise you can give an empirical paper. It's an important topic. It's a great example of no one really wants to read a VC paper. They want to read something about something else, and VC's the laboratory. I think this does a good job of that. The analysis is disciplined by institutional details, which is critical in these kinds of areas. And finally, it's really using the data without overselling. So I have three things in the 7 minutes to drinks. I think the motivation in this new draft, I have some strong suggestions. I'll be nice about it, but I think I would really rethink how that's done. I'm not sure the lesson is about data and finance per se. I think the paper tells us exactly where they're doing things wrong and how they can fix it. Namely, backward similarity tells us about novelty, so why not just load on novelty instead and you basically fix the whole thing? Could be wrong. And then finally, is this so bad? So let's think about the VC problem. So the problem in 4 bullets, well, 3. They invest in startups. The key is they only have 10 to 15 shots on goal, so they're not in this nice setting of, let's say, an evergreen fund. They have a time window. They have to sell these things within 12 years. And I would argue the most important piece is they have to keep doing this every 3 years. That is, raise a new fund. So every 3-4 years, they have to convince those same people, I'm doing a good job, renew me as associate professor without tenure, whatever it is. Same game here. Now, in that world, it's important to think about where data could matter. So on the deal flow side, which I think PhD mentoring, which students come to me, it's pretty clear that I could understand the role. I could use data in that world, how to select, adding value to a startup. Not obvious to me that that's where value add or where data would sit. And if there's any timing and luck, of course, data is not going to help you in that. So this paper is going to be, as Maxime makes clear, about the deal flow side. So as a sort of gut check on this, I looked at the data from my advising work with a data venture firm, and we've calculated returns. I've used this in some of my papers. These are just gross multiples of money. So what does a dollar turn into? And I just played a little exercise of looking sort of the past and a little bit closer to today. These are firms from 1990 to 2018. I just sorted by observed returns. It's a little small, but this is including the .com boom. So think of it's like, you want to think about where there's a lot of data, look at any venture data set. There are way too many rows in 99 and 2000. So if this is the kind of data set you'd use to build a model predicting success, what would you say? Well, you basically say internet technologies are where all the money's being made, right? So you look at routers and all the broadband stuff. So let's just take out, but this is the world you might load on, take out 99, 2000. Then now a little closer to the sample period, it's changed completely, right? You have grocery delivery, you have social networks, you have all these other things. This is a great validation, in my view, of the story that's being told in the paper, that they're using historical data. The world changes every once in a while, and you really shouldn't be running a predictive model looking for things that are persistent. That's kind of my first comment, is that the motivation of this paper is quoted here. Data technologies can generate accurate predictions within familiar contexts. Their effectiveness diminishes when things are rare and novel. My view on this, here's some words. This is sort of an obvious statement. I think anyone who does data scientists work and wants to run a predictive model, they're assuming that they're running regressions and thinking the world hasn't changed a lot since the data was created. It's just obvious. So what I view this whole paper as showing is that VC's data scientists aren't doing a very good job. The world changes in venture. You probably shouldn't be running predictive models in the way that they are. That's still an important result, but it's not how we should. We haven't learned much about data science. That's just bad data science, in my view. That's important. So it's true, rare event is actually a solved problem. It's a huge problem in lots of areas. So I don't think that's such a big deal. So my interpretation of this, there's three possibilities. VCs fail to recognize that past success are one-off. So no one's going to make billions of dollars laying wire in the ocean, right? Or building routers. Now that's doing whatever it is, makes money now. Persistent predictors are unobservable. That's another explanation. Or the third one is they're sitting on predictors and they just don't realize it. They're using the wrong one. So those are the interpretation of the paper for me. And no matter the interpretation, I just don't think the paper is testing whether data technologies are less effective at predicting rare outcomes. That's not what these results mean. And so I would just encourage the author to reframe things. Next comment is just this idea of flipping the script a little bit. So what backward similar firms look like is they don't fail as often and they don't go public as often. So you just sort of get more of the middle of the distribution. And VCs tend to switch here, which is a cool result. But all I could think of as I was reading the paper was, you're telling me something else at the exact same time, which is that novelty must predict the opposite. I know I'm simplifying things, but in a simple world, that's what this says. So these guys are loading on factors that get them similar firms that were in the past. So in a way, they just have to reformulate how they interpret their regression results, and they're picking the rest of the distribution. And so maybe I'm wrong, but to me, the appendix even says this. He shows with their data that disruptive big return firms are the non-backward similar. So they're doing it wrong in a very specific way. They're selecting these, but they should just be selecting the common. And they get sort of where they need to. And so I would discuss in the paper whether I'm right about this. And if it's a case, well, maybe you should start a firm and make some money off of it. But this only holds, importantly, if we're all thinking expected returns, right? So it only holds if this doesn't go up much more. So if I switch to novel, maybe I'm going to increase my failure rate so much that the higher success rate is offset. So that I don't know, and I'd like to see that in the paper. Another way to put it is, I think this paper just needs a section where it tries to run its own little data science model and just show, like, there's a little of it there, but show the positive novelty piece. So this is my framing suggestion, is that I really think you gotta tone down this trade-off where we're thinking about data science being done in a certain way. I assume every data science program at schools are teaching them to do it in the way where you're assuming historical data is informative. The world hasn't gone through some big structural break. And what I would instead focus on, these results show us that given this mistake provides an opportunity to show that venture capitalists are indeed gatekeepers for innovation. It's a middle part of the paper, but it's really powerful to me. It's saying, look, they make these mistakes and it matters for the economy. That's kind of cool. Finally, promise, 27 seconds, I can do it. What we don't know from this paper is whether this is actually bad. For whom? The VC. So a VC's job for their LPs is maximizing value. That's their fiduciary duty, but they care about that plus their careers. And so it's not obvious to me that getting rid of these two tails, selecting backward similar, doesn't change the game for them. That is, maybe I can raise more funds. And the reason I say that is the median fund in venture doesn't really break even, actually loses money. So you can imagine a world where, like, I switch to backward similar, low failure, weaker IPO, and I'm more likely as a venture investor to raise a fund. If that's true, then well, it just changes our interpretation of these results. It's not a mistake from the VC's perspective, it is from the LPs. Anyway, great job. I hope this paper goes well. I encourage you all to read it. Thanks.